Okay, welcome to another run through of the top 5 charts of the week. So this is the free weekly email that goes out, contains a bunch of charts and a little bit of commentary. And in this video what we're going to do is go through each of these charts and talk through them. So we'll start off with number 1 here, is the developed markets flash manufacturing PMIs. So in the red line here we've got the composite manufacturing PMI for all the developed market economies that release a flash PMI, which is sort of an early reading of the PMI. It's put together based on GDP weights. And the bottom line here is that with the August flash reading, it has pretty clearly rolled over, and that just extends what we've seen. Pretty much the peak was around the turn of the year. And that rolling over of the PMI is a key reason why we've seen the US 10-year bond yield capped at these sort of levels, just stuck in a range there. If we recall back in back end of 2017, when you saw that acceleration, that composite PMI, that was a key driver of that uplift in the 10-year bond yield. And the similar thing back in 2016, and that was a key call back then. It was a really useful chart back then to help pick that push up in bond yields then. So it's going to be pretty key to keep an eye on this one, because if that goes further, then of course that's going to set the tone for not just this market but many other markets. But in terms of what would need to happen to make bond yields do another push higher from here, we'd either need to see, number one, as a minimum, a stabilization in this PMI, so at least see it going sideways, and ideally in the background see an acceleration in inflation, or of course another push higher. And an example of that would have been back in 2010, 2011, when you saw that deceleration and then re-acceleration, which saw bond yields move in kind. So it's certainly one to be mindful of. And on a very similar note here, we've got the US 10-year bond yield seasonality. And so the red line here is the average movement in yields by business day across the year. And so it's basically what I've done is take the z-score of the yield, the z-score within each year of the yield across that period. And the reason I've done that is that it is basically the easiest way to summarize the signal, because you normally for seasonal patterns what you do is price percentage change, but since we're talking about a yield, it makes it a little bit trickier. It makes it especially tricky since you move from double-digit yields back around the 70s and down to very low single-digit yields more recently. And so you can't do percentage change in yield, because it would be very small when it's in double digits and very large when it's in low single digits. And you can't do basis points either, because it would give so much more weight to those years where the yield was in double digits, and the average basis point move is going to be smaller when the yield's low. But anyway, the key point of this chart is that the red line there is showing you the average sort of pattern across the year, across that pretty large time frame. Now I do note here that seasonality doesn't always work, but it's interesting to see that so far this year the 10-year bond yield has been actually trading fairly much in line with the seasonal pattern, and if that continues, then we should expect lower yields through the rest of the year, and possibly as low as 2.6. That's quite interesting, because that would be very much a non-consensus move. Look, the latest speculative futures positioning shows the market's still very short, so definitely one to be mindful of, especially in the context of what's going on for the PMIs there. Number 3 is the global trade indicators. This one's quite an interesting chart. So what we've got here in the blue line is the Baltic Dry Index, and the green line that's Dow Jones Global Shipping Stock Index relative to MSCI World, and the red line is China Containerized Freight Index. So basically 3 different measures of, well, really the shipping industry or shipping costs, and that's kind of taken as a proxy for global trade activity. And that grey line is just a combination of the signals. And you can see there that in that 2016, which we were talking about before, that 2016 period where we saw this global synchronized economic upturn, and you can very clearly see the turnaround in the trade indicators there. That recession in global trade that we saw 2015-16 was something I talked a lot about at the time, and it was pretty key for understanding the risk environment back then. If you were just watching that, you would have been on top of, you probably would have even been prepared for those twin corrections that we had back then. And then coming out of that, you would have, if you had been focused on the rebound in global trade, you would have definitely been on top of what went on in bonds, commodities, and equities. So, global trade is definitely one of those things that I watch very closely, and this is one of many indicators that I look at. But this is very interesting to see that after this, synchronized rundown and across the indicators, we're seeing this little bit of a rebound here. It's I wouldn't say that it's entirely convincing just yet, but it certainly goes against the prevailing narrative, which is global trade is collapsing and all this and the other thing. So definitely something I am paying a lot of attention to, and we're going to be writing about either this week or next week in the report for clients, the institutional report. Number 4, cross-asset volatility. Another sort of unusual chart. This one is showing the rolling 12-month sum of daily moves exceeding 1% plus or minus for commodities, currencies, bonds, and equities. And bottom line there is that after crunching down to the lowest levels, at least the equal lowest levels since the early 70s or in the late 70s, it's starting to turn up again. And what was driving that crunch in volatility? I guess a big driver really has been central bank policies. So if you think about this repeated stimulus and quantitative easing, Bank of Japan even not just easing, but actually even forcing volatility to be lower by constraining the 10-year bond yield within a cap. So, as we start to move away from these extraordinary policies, it would be quite natural to see a rise in volatility. So, I think it's definitely one to be mindful of. It's probably worth clicking that link and having a read through the article if this is something you're interested in, because I talk a little bit more about it. Number 5, last but not least, certainly not least, is a very interesting chart on Chinese A-share valuations. So, as I note here in the paragraph, a lot has gone wrong for Chinese stocks lately, and they've actually gone for a 25% correction. And what that's done to valuations is, if we focus first on the black line, which is China A shares total market index excluding financials, it's definitely worth excluding financials because, well, you can see the difference between the two charts. It sort of, gives you this reading which is arguably cheaper than, what kind of reflects reality in the blue line. So it's a good way of, getting a sort of a truer sense of the valuation picture for Chinese equities. That faint grey-black line there is the long-term average for China A shares ex financials PE ratio. And you can see that PE ratio is back below long-term average, lowest it's been since just before the 2015 stock market bubble began. And it's pretty key because back in this period here, this 2013, 14, 15 period, or before 15 rather, you could definitely call China A shares a deep value play. But, this period following the bubble is, you definitely wouldn't call them a value play anymore. And but now that we have seen this big correction and big adjustment in valuations, it definitely helps improve the risk-return balance. I still think the macroeconomic outlook for China is quite complex, but you know, should we see a more forceful policy response combined with cheaper valuations, that's going to make for a very interesting setup. And I talked about this in a bit more detail in the weekly macro themes report. If you want to have a look at that, just let me know. Just send me an email or just click through here. You can sign up for a trial. So you just go through, click the relevant one, fund managers, institutional investors, individuals, and yeah, take a trial, have a look at the report. Other than that, that's us for another week. So if you enjoyed this video, make sure you subscribe to the channel so that you don't miss any future ones.